Hello, Venevia community. It is Helmer. Today is May 24th, 2023, and we are here with your mortgage market update, letting you know what's going on with rates and the markets and all that good stuff. And this week, I am joined with our guest, Jerry Avila. Jerry, please go ahead, take a minute and tell everybody a little bit about yourself.
Yeah, so I'm actually, I guess, one of the original members of the group here. Had a great time kind of seeing the group grow to where it's at now. It's been fun serving in different capacities within the group and moderating and being able to answer questions. And so, just for myself, I'm an expert that's been in this business for quite some time. I've been able to, work on different angles of the business, all from modifications and deed and lose, short sales, and doing all that stuff, all the way through getting back into the broker community and being able to contribute on this level and this scale here, focusing my business mainly on VA. So a lot of what we've done here within the group has been basically something that's been near and dear to me, which is why I'm always here to contribute and help out in any way I can.
Awesome. Well, thank you for joining us today, my friend. Always a pleasure to see you. For everybody that's on here today, please go ahead, take a minute and tell us that you're here live. I see we've got a couple of people from the Vetted VA community that are on already today. So go ahead and say hello. Let us know if you're a consumer, if you've got any questions. If you're a mortgage professional, feel free to say hi to Jerry, say hi to myself. If you guys do have any questions, remember, we do this each and every week trying to help you guys to understand really what's going on in the market so that you can be well informed, as is one of the missions of the VA community and VA is to make sure that you understand and can best represent yourself. So if you're watching on the replay, don't forget to give us a hashtag replay. I know a lot of you can't make it live, but you do watch the replays and we love having you here. And with that said, let's go ahead and jump into the rate stuff, Jerry. We're going to go in. So I'm going to pop open the screen here and let's see. I'm going to here's our little disclaimer. Remember, we're going to talk about rates today, y'all. This is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. And you want to make sure that you go ahead and shop your rate. It's always the best way to make sure that you're taking care of yourself. So last week, I said, hey, rates are likely to continue in this range. We talked about the range. Rates had been moving up and down within about a quarter point increment. And I said they found an equilibrium for as long as conditions remain about the same, the economy, the Fed, the labor market. And that's kind of where we were at last Wednesday. And then what happened on Thursday? Well, poof, all of that went away. And actually, we have seen rates, start to move higher. I've seen rates move much higher in the last week. Jerry, what about for you? Have you seen rates move higher in the last week, or what have you seen?
There's definitely been an increment there on rates, and unfortunately, it's what the market is actually moving in that direction, and there's really nothing much we can do other than kind of really just continue to advise as best as we can. But yeah, it's been unfortunate because we just started seeing some more activity, and some people just get scared as soon as they see rates increase.
And that's a great point to bring up. Is should somebody be really afraid? We're seeing rates that are creeping up now, right? And what does that mean for somebody that's buying a home? In most cases, should somebody that was thinking about buying a house or out house hunting, do you think they should just abandon their search and wait for rates to drop again?
Not at all, because the difference in payment which you're looking at is really insignificant, to be honest. When you're talking about your average monthly payment anyway. So if we're talking about increasing the rate by a quarter, it's not going to have a huge, massive impact on your ability to make that mortgage payment. Even if it's half a point, yes, it's going to be an increase. But I mean, if you really take into consideration time and basically home values, because again, there's a shortage of properties available on the market generally everywhere. So by there being a general shortage of properties, that means that there's a scarcity, which means now that there's more demand, that demand is now going to create more higher values and higher costs, which is ultimately going to drive everything higher even faster than you are by just taking the rate that's available now. And then as soon as you're eligible to, and hopefully being able to do so within the next, let's say 6 months, 8 months, 10 months, a year and a half, 2 years, whatever that number is, you would be able to, generally, especially being in this group, obviously we're talking about a VA IRRRL potential. And so those are the kind of things that you want to take in consideration when you're doing that. Or if eventually, if the equity is there in the home, eventually use that equity to offset some of your debt that you have. So those are the kind of things that I like, when I'm discussing things with consumers, that's really the things to consider. Not every situation is ideal for this current market, but again, if you're in the purchase market right now, you're better striking fast and as soon as possible than allowing time to continue to pass, because that's only going to increase those home values.
Very good. So basically, if you are out there looking, rates for VA rates, we had seen them in the lower sixes. Now you're seeing them in the mid to high sixes. So you're seeing anywhere from 1/4 to 0.5% rate increase over time. As far as conventional rates go, if you're not getting a VA loan for some reason and you're using what we call a conventional loan program, you're going to find that rates are generally in the high sixes into the sevens, quite often in the sevens, unless you've got a lot more money to be putting down or, really optimal credit. So generally, you're going to see rates in the sevens for those loans right now. And it looked like we were going to be out of the sevens. It looked like they were in the rearview mirror, but they're rearing their ugly heads again. And, a lot of times people are like, Helmer, what happened? Why did this happen? So you can get a lot of different reasons. You get a lot of different explanations, if you will. And for some of you, you may be seeing the same kind of article headlines I see, and there's a lot of talk about the debt limit and the debt ceiling. And I know that some people have said, hey, Helmer, when if we do default on the debt, is that going to put mortgage rates up to 8% like Zillow claimed? And then other people said, well, maybe mortgage rates are going to get better if we get through this. So one of the things that actually, as much as this is great for headlines, because it lets Bloomberg gets to use words like doomsday clock and, time running out. The reality is there actually isn't a true deadline when it comes to when the U.S. will default on debt. And this is a complex topic, but I can make it really easy for you by telling you this is really not affecting your mortgage rates at all. It's really not. It's not affecting long-term bonds, the 10-year treasury. It's not affecting mortgage-backed securities, these fancy charts that you guys know that I love to show you, where we've got all these fancy Japanese candlesticks. Believe it or not, it's really not hurting you here. So although you're seeing a lot of headlines about this, this is not what's causing mortgage rates to go up. What's causing mortgage rates to go up? It's all to do with this other chart that I show you guys all the time. And these are Fed futures. So basically what's happening is that markets have gone from a position where just 2 weeks ago, we were at 99% probability that the Fed was done raising the Fed funds rate, that they were going to go ahead and pause at the June meeting. And expectations were in the markets that we were going to see rates actually start to come down, that the Fed was going to have to cut rates. And the reason the Fed would have to cut their Fed funds rate is to re-stimulate the economy. After 10 straight rate hikes in 14 months, everyone was like, hey, the economy is going into a recession. We're going to have to see the Fed lower this Fed funds rate to reinvigorate and stimulate the economy again. Well, we've had a splash of cold water in the face over the last couple of weeks, and markets have heard many, many of the different Fed members, whether it's Fed Chair Jerome Powell, Fed governors, Fed presidents like James Bullard and Neil Kashkari. They have talked about the fact that the Fed, if they do pause, which it's still expected that they will, that they may raise rates again starting in July, or that different Fed members that said, hey, I don't think that the Fed should be, that we should be pausing at all. I think we should continue to raise rates. I don't think we're done yet. I think we really have to quash inflation. So right now, you can compare just a couple of weeks ago when mortgage rates were lower, the expectation was that the Fed was going to pause their Fed rate hikes at the June meeting, and that by this July meeting, that we would actually see the Fed funds rate, instead of the current 5%, we would see the Fed pause in June and then cut in July. And the Fed funds rate would start to go down in July. And that was the expectation. That's what markets were pricing in. Well, once we started to recognize a lot of economic data is coming in showing the economy still doing strong. As much as people go and talk about that things are a struggle, you flip open Wall Street Journal and I see that, hey, all these people with all these summer plans, airfare is very expensive, yet people are still filling the planes. Hotels have become more expensive, yet people are still in the hotels. People are out there spending money and stimulating the economy. And as long as the economy is still ripping and roaring, what happens is the Fed is looking at, oh no, this is not going to allow inflation to improve. We've got to throttle the economy. We've got to slow this thing down. We've got to get the labor market to weaken, maybe not so many new jobs. So all of these things going on have actually put us in a position that the Fed is expected to be more aggressive over the upcoming months. They're going to possibly raise again in June. Right now, about a 30% probability that the Fed would raise rates in June. They're not going to cut in July. Right now, there's a probability that they would either stay at the 5% we're at now or be even higher. And the soonest that we start to see the idea that the Fed could actually cut rates into the fours again, it shows up a little bit in September's meeting. Probabilities by November's meeting a little bit higher. So the better rates, if you will, are expected to come later in the year now. And that's kind of what we're looking at. And that's what drove this rate increase. And it's important that you guys realize that that's the reason we're not going to see rates coming down anytime soon, because the expectation is rates are not going to drop until we get data that shows the economy is slowing down and that inflation continues to decline, and it takes the pressure off of the Fed so the Fed doesn't have to raise those rates. And if you're a consumer right now and you're thinking of buying a home, and Jerry, I'm going to come back to you in a minute to talk about this. If you're a consumer right now, you need to recognize, okay, this is the condition that we're looking at over the next, probably 6 weeks, maybe eight weeks. Do I still want to be in the housing market? And Jerry, you talked about this already, a minute ago, but just reiterate, when's the best time to buy a house?
It's really always going to come down to when you're ready, basically, right? It's when you're ready. Do you have the money? Do you want the house? And do you have a need for a place? Like if those things are checked off, I mean, the necessity is there. That means you need to just take the moment and just run with it, because I mean, the market's just fluctuating so much that at this point you're just going to continue to see the same pattern of, home values going up, and then also seeing interest rates continue to go up right now. And hopefully we'll see it soon come down. But I mean, how soon that is, who knows?
Yeah. And, again, I've been in the mortgage business for over 23 years. I've been forecasting rates for well over a decade. And, these are one of those things that it's a very fluid movement. It's like a weather report. We could say, hey, it's going to rain on Saturday. And then all of a sudden a cold front pushes in from the north. And then we say, guess what? That got pushed south. And now we're not going to have rain. You have to be changing because the conditions are always changing. So right now, with rates being a little bit higher, it's not likely, y'all, that we're going to see rates go much higher. We've seen them cap out maybe about a quarter point higher than where they're at today. And that's probably that ceiling that we would see again. We're not going to see rates go so high that you have to worry about being priced out of buying a home. But Jerry, why is now a good time to buy a home when people are scared and rates are a little bit higher?
So basically there's less competition. When there's less people flooding the market to try to buy property, yes, there's still an abundance of people out there, right? There's still people out there purchasing. So the difference is that it depends on the person who really isn't just like 100% fearful of like, oh, there's the housing crisis going to happen. Is there going to be another bubble, blah, blah, blah. Like, none of that. Like you have to have somebody who's sure that they know that what their needs are, they know exactly what needs to happen, and they're paying attention to the experts that they're working with to know like, hey, this is what the trajectory looks like. Are you ready to make this move? Because if you are, let's make the move quickly, because the sooner you move, the better. And a lot of times that's what it comes down to. And some unfortunate people have gone through, I mean, I'll just tell you from my own experience, I've had clients that basically held on. And then all of a sudden they were like, oh man, now we're priced out of where we wanted to be. It's like, yeah, the same house you could have gotten back then, you can't afford it now. And so those are the type of things that you have to really, try to bring to the forefront for people to understand. But that's really the necessity. It's like it's going to be whenever your time is, which is now. If you can afford it and you want it, let's make it happen now before it's too late.
And then for somebody that's concerned about buying a house now and maybe, being in a housing bubble, do you think we're in a housing bubble?
No, the problem is that in order for us to be at that point, there has to be more supply on the market. There's not enough supply. There's too much of a demand for property, and due to that, we're not going to see something where it's like, oh, home prices are going to elevate, and then all of a sudden the bubble's going to burst, and there's going to be thousands and hundreds of thousands of properties in the market in foreclosure. That's not going to happen again. In my opinion, like based off of what I've seen, and I mean, I was there for the initial crash. I'm telling you right now, like that, I don't see any of those signs happening right now, with all honesty. And so it's just you have to take in consideration that the experts that you're talking to and that you're working with are at least somewhat connected to the market and understand what's happening around them, and they're not just going based off the doom and gloom, like you were showing earlier on some of those articles. It's like, they try to use that fear tactic. Fear tactic is always going to be used, and it's never the right time to buy, especially if you listen to certain people. It's never been the right time to buy over the last 15 years. Yet somehow, there's people that have made hundreds of thousands of dollars of equity, right? Like,
exactly. Yeah.
Come on, like let's just be real here.
And for those of you watching, one thing that I can tell you is that house prices will only drop significantly if we see a huge jump in unemployment. So if the labor market and not like right now, the labor market's a little overheated. It's actually, there's still a strong demand for workers. We need that to level out a little bit, and house prices will be fine. If we were to see a huge change in the labor market where people were getting laid off in droves and businesses closing, that's what drives housing prices down, because the house, let's face it, if you own a home, the last thing that you're not going to pay is generally your mortgage, right? And that's the only time you're in that situation is when business gets so bad and you're not making any money and you lose your job. And when you have widespread job losses, that's when it leads to a lot of people that can't pay their mortgage, which then increases the inventory that Jerry was just talking about. And you get this is what happened in 2008. We had a sudden influx of inventory. And then when you have more inventory coming in all at once, that drives supply up, which then drives prices down. And that's the only way we would see something where we'd see significant drops in value. And we're not in a market for like that at all. So it's very unlikely that you're going to see that. Don't let that be a reason that you wouldn't buy a home today. In fact, I would absolutely. Now, Jerry, what if somebody does buy a house today and they end up with a rate in the high 6s or maybe even in the 7s? What is their incentive if they say, Jerry, but if rates go down a year from now and I bought a house and rates are in the 7s, what can I do?
Yeah, so that actually came up on a post this morning, actually. So it's a great thing you brought that up. So the VA IRRRL is definitely an option at that point in time, right? Because now we're talking about there's a few caveats, right? You have to be in that loan, and you have to pass 210 days from the first payment due date. You have to have an interest rate reduction that's more than 0.5%, and in essence, you have to recoup that whatever that increase of money that goes back into your loan has to then be recouped within the 36-month period. Now, when you have a VA IRRRL, which stands for VA interest rate reduction refinance loan, that loan will then allow you to basically go through a streamlined process where there's no income verification, there's no appraisal. Essentially, we're basically jumping from a higher rate down to a lower rate. As long as it improves by 0.5%, then you're good to go. So that is a post that's actually active right now in the group. So that's something that people can reference back to in case they have questions.
Yeah, and and that's something to keep in mind is that especially if it's your first time buying a home, it's going to feel like, oh my goodness, I do this and I'm committed forever. And take it from me, who has bought many homes. I've lost a home when the mortgage industry crashed in 2008. I went broke and I lost my house and had to short sell it. I've been through all those different scenarios. So being in there, you start to realize, you know what, if I can afford this payment, if I'm comfortable with where things are at now, it's a good time to buy. And I won't be in this loan forever. I won't be in this house forever, most likely. The term the HGTV term now is forever home, right? But how often do we ever actually get that forever home, especially as a first or even a second home? And for a lot of our veterans, you may be moved around. If you're active military, you may you may have to relocate. So don't necessarily get caught up in those details of worrying about, is this the optimal time, and are the stars aligned, and is everything perfect? Because you'll have opportunities for like an Earl, or what about somebody, if you buy a home and equity increases. You mentioned that they can refinance without an Earl before, and maybe save some money on debt.
Right. So the alternative is do a cash out refi on your home and then ultimately pay off other debt, because sometimes you have to think about it as it's the interest that's compounding interest versus a fixed interest, right? So the compounding interest is always going to continue to increase, and over time you're going to pay way more than if you just basically take a lump sum out of your home, pay off all of your debt, and ultimately carry that in over here. Now you have a fixed payment for all that interest that you would have been normally paying over here at a much higher percentage rate. So it's just a way for us to be able to help in facilitate ease and freeing up some of the access to money that they have currently by simply eliminating debt. And ultimately, yes, it's increasing your home's mortgage, but in turn, it's kind of a give and take. It just depends on the scenario. It's not always the right thing to do. But if you have $100,000 worth of debt and the payments are getting a little bit difficult for you to continue to make, and that doing a cash out refi is going to increase your payment, sure it is, because interest rates are higher. Let's say you got your interest rate when it was at 2.75%. A lot of times the alternatives are cash out refi or getting a HELOC. One of the two is going to end up being the better option. And we just have to determine what that is and whether or not it's even a viable option for you at the time.
So if you guys have any questions on that, it's a great thing that you can post in the Vetted VA community, and you'll get lots of the moderators that can explain that for you. Otherwise, kind of to bring it home and wrap it up for this week, we'll just kind of reiterate that rate forecast one more time. Rates are not likely to drop, and I say significantly, meaning some days are always better than others when it comes to mortgage rates. We see mortgage rates change day to day. They can even change during the day. And when I say rates aren't going to drop, it doesn't mean that you may not see one day that's slightly better than, maybe today is better than yesterday for locking in your interest rate. Maybe your closing costs are a little bit cheaper because you get more of a rebate from the lender, or maybe the interest rate is just slightly better. But at the main point is, you're not going to see rates really move down with any consistency or move down significantly until we see signs, like I said, that the economy is slowing down, that inflation continues to decline. If you have, if you're currently under contract to buy a home and you're like, hey, Helmer, I'm not locked in yet. Well, of course, you should have that conversation with your mortgage professional, but it is likely over the rest of this week, we've got the holiday. And we're seeing some signs that, we're seeing rates creep up every day, a little bit worse than the day before. And, that could continue through the end of the week. We may see things kind of level off right before the holiday. Sometimes we see a little bit of a, what we call a move to safety, where the stock market invests a little bit more money into the bond market to keep it safe over that holiday weekend while everyone's out partying. And in that time, you'll see mortgage rates can kind of stabilize. But at the end of the day, the next big event is June 2nd. We're going to get labor market data. And if that labor market data shows the labor market is still strong, well, that means it's going to hold rates higher like we see now. It would only be if we start to see signs that the labor market is weakening that maybe we see a little bit of improvement in rates, but we're not going to see a big change. As far as the next few weeks go, maybe you're out house hunting. Maybe you're like, hey, I'm haven't found anything yet. Do I have to worry about rates shooting up into the 8s? And that's very unlikely. Of course, nothing's ever written in stone, but it's very unlikely. Rates are only going to improve over the next few weeks, though, if the job data shows the labor market is weakening and inflation data shows that inflation is coming in surprisingly low. We have a Fed meeting on June 14th, and that will also kind of give us an idea of what's happening over the next few weeks into the next few months, eventually rates are expected to fall again, and they're expected to fall back down into the fives at some point. But that's quite a bit ways in the future, not something that you should be making any decisions on today, waiting for. Again, we talked about your options with an Earl refinance or with a cash out refinance that could come later as those opportunities are there. So that's it. Anything that you want to leave everybody with, Jerry, before we wrap up for today's call?
No, just to kind of reiterate what we talked about, which is, just remember it's whenever it's the right time for you guys. If you're ready to buy a house, it's because you're ready to buy a house. I mean, if there's a want, a need, and a desire there, and there's an opportunity, then take the opportunity, because you're never going to get the equity gain that you're going to get from that in a rental. Like, you're always going to pay money to somebody else in a rental versus being in a home of your own, where you're going to build equity based off the money that you put back into your own home, basically, but just by making your mortgage payment. So you'll never get that on a rental. So that's the only real thing I would say. Just really think about that as an alternative to just oh, you know what, rates are going up, I'm going to rent. It's not the best choice almost 90% of the time.
Great advice. So if you guys have any questions, we are watching those comments, so feel free to go ahead and post them, and I will, Jerry or myself can answer them for you. Otherwise, we're going to wrap it up. Remember, you can join us each and every week. We do this same time every week. It's on Wednesdays, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. Love having all of you here. We're here for you. If there's something that you think we can do that would make this even better for you, let us know. If you like the format, I definitely love feedback. I'm a big feedback guy. So if you do like what we do, if you like the format, you like the slides, you like the info, please put it in the comments, especially those of you that are consumers out there. That's the reason that we do this show for you each and every week, is so that you guys are well informed and well armed, and you have all the information at your fingertips. So, Jerry, thanks again for joining us, my friend. We're going to say goodbye to everybody. Bye-bye.